and welcome to this short introduction to budgeting. Budgets are usually defined as something like this: a financial or quantitative plan. It's for a future period and it's been authorised. If it's not been authorised, it's really just a forecast. Budgets are part of the total business planning process. Here they are in the middle, after the more broader strategic plans and before the day-to-day activities and monitoring of results. Budgets have three key objectives: planning, coordination to make sure everybody's working towards the plan, and control, also to try and keep to the plan. Budgets are also intended to motivate employees towards the achievement of the objectives. However, because you're dealing with people, there are behavioural aspects of budgeting, and research has shown these to be complex, often contradictory, and they're not really very well understood. Nevertheless, they're all we have, so most businesses have a go at this, and most businesses produce an annual budget. And this may be made up, the budget of the whole organisation may be made up from budgets for various parts, for sales and revenue, operations, various departments that are not operational, project budgets, routine activities, and capital expenditure. The budgets that are prepared are usually based on expected transactions, such as a shipment or receipt of goods and the consumption of services. This is the basis on which the income statement or the budgeting income statement will be prepared, and it's known by accountants as the accruals basis. A cash budget will usually be prepared as well, which will show the timing of actual payments made and received. Budget preparation often starts with the sales budgets and proceeds as shown in the diagram here. Some organisations will not need to consider materials or manpower for operations. Requirements for materials and operating manpower can generally be calculated from sales, whereas on the right-hand side of the chart, things like selling expenses and other non-operating expenses are less directly affected by changes in sales volume. The box at the bottom showing the income statement and statement of financial position, that is to say the forecast income statement for the next year, and the position at the end of that year, are often known collectively as a master budget. There are two key ways of preparing budgets. Incremental budgeting produces figures based on the previous year's budget, and these are adjusted by an appropriate amount depending on circumstances. Zero-based budgeting, which is much harder, ignores all the previous results, and each item has to be justified against the objectives for the new budget period. Incremental budgeting is therefore much more common. Whichever approach is used, the preparation of the annual budget for an organisation is often led by a budget committee, served by a budget officer, usually somebody from accounting, who is responsible for coordinating the budget activities. There may also be a budget manual or handbook showing everybody the key objectives, who's responsible for what information is required, and what the timescales are. Budgets may be prepared by budget holders and then reviewed by senior managers. This is known as bottom-up budgeting. It takes advantage of local knowledge, and it can improve managers' commitment to the final budget. With top-down budgeting, Lower level budget holders are not consulted. This approach reduces the time and the costs of the process, and it can reduce budgetary slack, which is a tendency of lower level managers to overestimate their expenses or underestimate their revenue. The master budget will eventually be presented to the directors or the governing body of the organisation for approval. Several iterations of this process are likely before approval is obtained. Usually the first time round, the profit is unsatisfactory, so adjustments have to be made. So here is a sample of a budget for a small organisation. It's for a year. In this case, the first 3 months are shown in more detail than the remainder of the year. That's budget preparation. Moving on to budgetary control. With this, actual results are regularly compared with the budget figures for the whole organisation and for individual departments and for projects. The difference between the budget and the actual is a variance, and this may be favourable if it increases the profit, or adverse if it reduces the profit. The causes of these variances should be discovered and corrective action taken if necessary. Budgets can be fixed or flexible. With a fixed budget, the actual results are compared with the original budget. With a flexible budget, the budget figures are revised regularly to reflect changes in the original budget assumptions. In that case, variances should reveal genuine problems or opportunities. So here's an example of a budget for a department, a fixed budget. Okay, so this is the budget you start off with, and then the actual, this may have been done at the beginning of the year. This is now March. The actual figures are shown, and the differences are shown as the variances. Note that the total variance on this presentation is £3,042 adverse. So they've spent £3,042 too much compared with the original budget. This is a flex budget for the same situation. So what's happened, because if we go back to the previous one, the original plan was for 1,000 visits. Because there were 1,125, we've made some of the budget figures bigger to reflect the changing circumstances. Now look at the variances, and some of them have changed, and we've actually got a favourable variance of £703. Okay, so the previous budget was unrealistically low. It's usually unwise to base management decisions on a single month's figures anyway, so it's often better to show a longer period of time. So here's an example showing 3 months and comparing the expenditure over the 3 months with what it should have been for that period of time. If you'd like more information on this topic, please follow the links on the next page. Thank you for your attention.